On behalf of the Association of Credit Rating Agencies in Asia, I'd like to welcome you to our third of a series of webinars, updates on capital market developments in countries represented in ACRAA. The first one in the series was about India and China. The second one was on Malaysia and Thailand. And this is the third of our series, Bangladesh and Pakistan. And excuse me, we shall have two speakers as usual. The first one will be presenting the updates on Pakistan, and the second one, the updates on Bangladesh. May I introduce to you now our first speaker, Mr. Muhammad Shahzad Salim. And although you have a projected in your screen right now a very brief description of himself, he is really a fairly young man compared to some of us, like myself. Mr. Muhammad Shahzad Salim is the CEO of ACRAA, Pakistan Credit Rating Agency, since January 2020. He is a CPA and a distinguished member of the Institute of Chartered Accountants of Pakistan. He has been with the, as we said, PACRA in 2000, in the training section portion of the rating agency, and in such a short time has become the Chief Executive Officer and now representing PACRA in ACRA. So he is in a way a fairly new, one of the new faces in ACRA, and let us welcome him warmly to make his first make the first of two presentations this afternoon. So, Mr. Shahzad Salim, may I invite you now to make your presentation. I will introduce Muzaffar a little later. Go ahead.
So thank you, Santi, and thank you all the members of ACRA for coming for this particular session. I would just like to add something to the introduction that Santi has made of me. So that I am in the rating business for now more than 21 years. And it has been a long journey actually to become the chief executive. And I appreciate that he called me young, but that's good to hear. So, so thank you. Okay, so firstly, I would like to appreciate ACRA for this particular initiative, and the reason being, this actually is giving a good opportunity to most of ACRA members to see what's happening in other markets. Usually, I have seen that we remain more focused on what's happening in our own market, and sometimes we actually overlook the developments in other markets. So this particular series that we have started, this is giving us actually a very good opportunity to see what's happening in other markets and how one can actually relate the developments in one's own market with other markets. And more than this, I think it offers some of, on one side, learning opportunities, and at the same time, some sort of growth opportunities as well, in the sense that during this presentation, I have seen quite a bit of things happening in other markets, which probably are not happening in Pakistani market. And the case would be vice versa for a few of other markets as well. So I think that's something really valuable that's coming out of this particular series. So thanks again to ACRA and everyone who's actually taking this initiative forward. So now I'll formally move to my presentation. The topic right now we are discussing is Pakistan capital markets. Since we are not the first one putting up a presentation in this series, so there already certain presentations have been made, so which means a course has been set to some extent. So what I have tried to do is I've tried to sort of capture the things that have already sort of presented by other countries so that the audience can actually compare different countries, and at the same time we have tried to bring certain things which are very specific to Pakistani market forward as well, and we have tried to structure our presentation in terms of capital markets between the equity market and debt market, and then in terms of debt market even we have tried to shed some light on government securities as well. So firstly, I would like to actually give a bit of perspective with reference to overall economy of Pakistan. I think that would help all the participants to place our numbers in a more sensible way. And at the same time, we have tried to present all our numbers in US dollars so that comparison becomes much easier. Although in rupee terms, had we made our presentations, the number would have been reasonably big, but now the numbers are coming up actually small. So firstly, of course, as an economy, Pakistan is a shade less than $300 billion economy. In our local currency term, we have seen reasonable growth. But if you look at this particular line that where we are showing the behavior of our currency against US dollar, you can see that over the last couple of years, we have seen quite a bit of depreciation in our home currency. So for that particular reason, our economy in US dollar terms hasn't performed reasonably well. But in nominal terms, in our own currency terms, it has more than doubled over the last 10 years. This means that when actually you come to Pakistan and you actually see the real economy, you see a prosperity that has been coming over the last couple of years. But of course, in dollar terms, there are few bits that we have to catch up. So as a country, our economy is predominantly led by service sector, which contributes something close to 2/3 towards our total economy. That's followed by agriculture and industries equally. And over the last few decades, the structure of our economy have changed. We used to be an agrarian or agriculture economy, and then from there we moved to industry side, and now we have moved significantly towards the services side. And even when we try to look forward, I think this is the structure that our economy would largely represent. Probably agriculture may go down a bit, and industrial side may improve a bit. So that's how our economy is going to be composed of even in the days to come. When you look at our numbers, so interest rate has been in sort of a good range, around 7%. But the challenges that you can see in our particular as a country is, of course, the currency side. But the good thing recently is that we have managed our current account deficit reasonably well, though our trade deficit is significantly high. But as a country, most of you may be aware that Pakistan has a very strong sort of a non-Pakistani presence across the globe, and there is a significant inflow of foreign remittances. So that's the reason our current account deficit is this much low despite having significantly high trade deficit. In terms of our sovereign rating, so we are rated B- or B3. That's of course not very impressive, but considering our size and the type of challenges that we have, this rating actually demonstrates quite a bit of confidence on the country. So I would just like to give a bit sort of a overview of the financial sector, the way it's designed in Pakistan. So we have reasonably good financial inclusion in the country, and we have financial institutions available in almost all the domains where they usually operate. And in terms of Pakistan, our regulators usually prefer less number of institutions, but at the same time, they want to see them reasonably strong in terms of their risk absorption capacity. And probably that's the reason there has been a lot of mergers, acquisitions in the last couple of years in Pakistan. And I think the numbers that you are seeing on your screens, they are now quite a bit have stabilized. Over here, an important dimension that I would like to highlight is actually our capital market participation. Here you can see that we have quite a bit of debt securities trustees. There is a reasonably good number of brokerage firms, asset management companies are also there. And in case of Pakistan, we have just two exchanges. One exchange, which is Pakistan Stock Exchange, is responsible for the equity and debt side, and the Pakistan Mercantile Exchange that basically deals in the commodities. We used to have multiple exchanges, but as I mentioned earlier, our regulators usually prefer smaller number of strong institutions. So they have led to the merger of multiple exchanges into one exchange. And lately, in Pakistan, the capital market or exchange has remained focused on the equity side of business. So, but lately, the interest towards that market is also improving. And as an outcome of that, you would see on the stream right bottom, there are good like 15 debt market makers that have lately come up. So I think this would help positively in development of debt market in our country. So now we'll take you a bit more into the capital markets of Pakistan. I have given you a reasonably good overview of our country. In terms of capital market, of course, we look at two sides. One is the debt side and other is the equity side. Uh, and to actually put things in perspective, so this is a reasonably good analysis that actually the team at ACRAA has done. And I think this would help everyone, all the participants, to see where as an economy we stand compared to theirs. Uh, Maybe not the good part that we are almost at the bottom, but there are so many good things that we are doing. So what we have tried to capture here is we have tried to put most of things in the perspective of GDP. We have used GDP as a sort of a common denominator for identifying the relevant significance of different elements. Over here, you can see that we have identified first the important element is the government debt as a percentage of GDP. In absolute terms, firstly, because we think the government debt is an important number because in so many cases, the government has been a key participant in the debt market as well. So it's important to understand the capital market in any country. I think it's also important to understand the structure of the government borrowings as well. And then when in the second portion of this particular slide, you see the capital market, the data on the capital market. Firstly, we have tried to explain with reference to the equity market that how it compares in terms of GDP. Over here, the very interesting bit is the most of the countries, the equity market is a significant portion of actually the GDP. Probably the only two outliers are the countries which are presenting today, Pakistan and Bangladesh, where the equity market is very small percentage of the overall GDP. So the next column, we see the debt securities with reference to GDP. And over here, of course, again, Pakistan and Bangladesh are at low end compared to so many other countries, but in case of Pakistan, debt securities form a significant portion. And this is followed by another interesting analysis where we have put down the number of total debt securities in US dollar terms. And then within that debt securities, we have tried to bifurcate how much of these debt securities are government debt and how much is corporate debt. And as a rating agencies, I think the last column is the column which is most important for all of us, because that's the column that actually tells the size of the eventual business that's available to the rating agencies from the perspective of ratings. And here, Santi, probably in days to come, I think another help that ACRAA can do, ACRAA can actually tell us in terms of the penetration of rating agencies in the respective corporate debt securities. Because the last presentations that I have seen, so and when I look at these numbers, then the ratings done by rating agencies are less compared to the total corporate debt issued in that particular country. That actually one way or other way tells the room available to rating agencies as well. But in case of Pakistan, otherwise, when you see, so our corporate debt is quite small. That's just $4 billion. And when you look at it from the perspective of total debt securities, which are close to $123 billion, so actually it looks very minuscule. And on a relative basis, when I compare it with other ACRA members, so there is a lot of room actually apparently available to Pakistan in terms of building its corporate debt market. So I think this particular slide is important in the sense because it's putting all the ACRA members, underlying economies, and relevant penetration of debt market in perspective. And to me, this also highlights the room available to the rating agencies. Now I'll move more specifically into Pakistan capital market. So as I mentioned earlier, our capital market is dominated by the debt side and followed by equities. You may be seeing that over the last 2-3 years, there has been a dip in the overall size of a capital market in US dollar terms. The reason is very clear. So our currency has lost significantly compared to US dollars. But the latest year, there has been a reasonably high growth, especially in our equity market. And that's on the back of otherwise positive outlook on the economy. And at the same time, of course, there has been an increase in the government debt as well to support the economic activity. Pakistan's equity market has been reasonably volatile in the last couple of years, and our market, in addition to the underlying fundamentals of the companies, our market is still prone to the developments on the political front and otherwise on the geographical fronts as well. So probably that's a key reason for relatively high volatility in our markets. And then, as I mentioned earlier, sorry for repeating it again and again, but the US dollar has been again a reason for significant decline in the size of our debt market. In terms of the industries that are being represented on our equity market, there is reasonably good diversification, and almost all the key sectors of the economy are being represented on our stock market. There are 600 companies that are listed on our stock market. They are predominantly from the financial institutions and energy sector. And in terms of energy sector, there is quite a bit of penetration, or the energy sector has preferred to access the capital market for raising required capital. This is followed by food and consumer, and then infrastructure and related industries. So in terms of its design, Pakistan stock market is reasonably well diversified, both in terms of the number of entities that are listed and at the same time in terms of the sectors that are being represented on it. So I think a major risk that we usually look at is concentration. So our stock market otherwise has lesser quantum of that particular risk. The next slide, this is again a depiction of the volumes that are being traded in our stock market and the return that our stock market has offered. And here we are showing the return both in rupee terms as well as in dollar terms. But the important point that I would like to highlight here is, and that's shown in the form of bars, is the volume that's being traded in our stock market. And when you look at it, even visually, one can see that there has been a gradual improvement in the volume. So that otherwise shows the increasing depth of our stock market. And I think it is a good sign in terms of attracting new investors towards the stock market. And here, there are few recent developments that I would also like to share in terms of the regulatory framework that's right now being developed in Pakistan. So over here, our regulator has been reasonably aligned to the developments in the global market, and accordingly, you can see that even in Pakistan now we have come up with the regulations that actually support the startups. At the same time, our regulator has done a very good step in terms of creating the or introducing the concept of regulatory sandbox, where actually they provide a tailored regulatory environment to test any new ideas. And so far, there has been two distinct ideas that has been checked under this particular regulatory sandbox concept, and those have been really good. So one of those ideas is crowdfunding, and it's right now being tested. Results are being evaluated, and if the results turn out to be favorable, then the regulator is likely to come up with a separate set of regulations for crowdfunding. So the basic objective of regulatory sandbox is to try new ideas in a relatively controlled regulatory environment, and if the results and response are positive, to come up with a framework for allowing such sort of new businesses to come in. In terms of our stock market, another recent initiative has been the permission to launch exchange traded funds. The idea is reasonably new to Pakistan, but since it has picked up reasonably good, almost in all the economies where this idea has opened up, I think in the days to come, probably in Pakistan, that would also become a good vehicle to invite new investors to the stock market. So far, there are 4 exchange traded funds that have been launched. Okay, now I'll take everyone to the debt market. And here, the important thing is, again, I would like to put the perspective of our debt market from as a comparison to our GDP. And here you can see that Pakistan had, as I mentioned earlier, we are having a GDP of $285 billion, and our overall debt market is close to $150 billion. That makes it something close to little above than 50%. And when you look at it, over the recent years, there has been a consistent growth in the size of overall debt market of the country. Here, the important point is who dominates our debt market. So in case of Pakistan, it's the government that dominates that debt market. So even if we look at our recent numbers, out of $150 billion debt market, $147 billion belongs to the government, and the corporate actually contributes very less. But in terms of design of the debt market from the perspective of government securities, the important thing is it has quite a bit of diversity, and the government borrowings are reasonably well laid out between the long term and short term. And a recent trend that you can see here is the government is also issuing the debt securities under the Islamic form as well. So, and Pakistani government has also managed to mobilize funds from the markets outside Pakistan as well. But in terms of our composition, our debt market design over the recent few years, you can notice has changed from a short-term debt-heavy government borrowing structure to a reasonably balanced government borrowing structure, and which is now actually aligned to the structure that most of the governments follow globally, where the long-term debt represents actually a significant portion. In terms of percentage, as almost 2/3 of our total debt is in long-term form, and the Islamic side is gradually picking up and now represents close to 6% of the total debt market. Over the years, of course, the noticeable change is the composition of the government securities in favor of long-term paper. Over here, another important thing to understand, I think any country's debt market is also to look at its interest rate environment. In case of Pakistan, we have rather we don't have a stable interest rate environment that you can see from this particular depiction as well, where our interest rates have moved significantly from a high of 14% few years back. It has come down to now close to 7%. And when we look at the last 10 years, so this has been trend every 4 or 5 years, where our interest rates move up and then they come down. Over here, a recent trend that I would like to highlight, that's an important actually development in Pakistan in terms of the maturity of its debt market, is the relationship between long-term and short-term yields. And you can see here that the market actually started predicting that the interest rate curve is likely to go down, and that is actually represented well in the yields of government and the long-term and short-term instruments. And actually the curve inversed, and then over here it has again normalized. So we, as a rating agency, we actually see it positively in the sense that it tells us that the different market participants now actually have built the ability where they can understand the overall economic framework of the country better, and then accordingly they can identify the likely trend in the interest rates. As if you recall, I have shown you the overall sectoral dimension of our equity market, and over there the point that I highlighted was that our market is reasonably diverse and it doesn't offer any concentration. But when we come to the government securities, there is a different type of concentration, and that's in terms of investors. So in Pakistan, the government securities have high concentration in terms of investors with banks. So banks have something like close to 80% of government securities are picked up by them, and then it's followed by other type of financial institutions. And non-financial institutions, which is corporate or individuals, that represent just 10% of the total pie. So I think that's an area where there is a lot of room for improvement, and actually if this particular room is availed well, so that may help even our government to further improve its cost of borrowings. Now the question comes, what's the reason why banks are so heavily invested in government securities? So the reason is very clear. The interest rate being offered by the government to the investors is significantly high compared to other opportunities available in the market, and the country is experiencing reasonably good deposit growth. So the financial institutions usually prefer to put their money in this low risk, high return avenue that's being offered by the government. And another reflection of that is that in case of Pakistan, the advances to deposit ratio of financial institution usually runs very close to 50%. So which means half of the money that they mobilize, they just put in the government papers. So this brings us towards the last critical section of our today's discussion, and that relates more to the corporate securities. That's an area which actually more relates to the rating agencies. In case of Pakistan, usually the long-term paper are called term finance certificates, the short-term paper are called commercial papers, and Islamic instruments are usually called Sukuk. But for ease of reference, we have classified all type of instruments between this long-term, short-term, and Islamic. When we look at our recent numbers, so this particular bar actually tells the amount outstanding in US dollar terms of the corporate debt securities issued, and this actually line tells the number of outstanding issues. This doesn't show actually a very healthy picture, in the sense that over the last 10 years, we have not been able to significantly enhance the number of outstanding issues. We are still stuck somewhere around 100 issues. and which means that the overall size of the debt market is not increasing. And similarly, the amount outstanding in terms of the securities that corporate have issued actually has come down significantly. It is $3 billion, and even 10 years back, it was $4 billion. So that tells you that it's not that the corporate are not borrowing in Pakistan. Why actually they are not approaching capital market? Because it's much easier for them to borrow directly from the commercial banks. And since when you have good terms available from commercial bank in bilateral arrangements, usually the corporate, they don't prefer to come to the capital market. Of course, capital market, the first and foremost, the capital market requires higher quantum of transparency. And then at the same time, at least right now in Pakistan, the cost of issuing debt is slightly higher compared to cost of borrowing directly from commercial banks. Now, in this small portion, what we are trying to show you is that in terms of our outstanding instrument at the end of the recent period, the Islamic actually type of instruments dominate. Why in terms of our debt market, Islamic instruments are so high? Because there is a large portion of investors in Pakistan that one way or other way prefer Islamic type of instruments. And the investors who are indifferent. So this, if a particular corporate is issuing debt security under Islamic mode, it is able to attract both type of investors. And Islamic instruments are usually long-term in design. Just a brief sort of intro that how the regulatory framework in Pakistan works. The important thing, we have Securities and Exchange of Pakistan as just one single regulator that takes care of the entire capital market and debt market side in Pakistan. And this last bit is actually really important, that highlights otherwise quite a bit of good opportunity for the rating agencies, in the sense that in Pakistan, you cannot make any public offering of a debt instrument unless it's rated. And at the same time, the regulator has also identified a minimum rating requirement. So in terms of regulatory framework, there is quite a bit of support available to the rating agencies, but in terms of corporates' preference for issuing capital market instruments, still it's not that attractive to them. So slightly a bit more into those instruments that have been outstanding in Pakistan. So those are dominated by financial institutions, followed by energy segment. In terms of financial institutions, most of these instruments are a capital adequacy ratio supporting quasi debt, quasi equity instruments, or in terms of the Basel framework, these are basically tier 1 and tier 2 debt instruments. So because of this particular opportunity available to the bank to support their capital, there has been a reasonably good trend of issuing instruments. So all the banks in Pakistan, or rather a significant number of banks in Pakistan, have actually availed this particular dimension of capital market for supporting their capital structure. In terms of energy, the number and the size appears high. The reason is there are few energy players which are reasonably active in approaching the short-term market by issuing commercial papers. So that's why there are high numbers. So rest of the instruments are coming out of quite a diversity of underlying industries. So this actually highlights one more thing, that the investor in debt instruments still, as against sector, is more reliant on the underlying entity. Over here, what we are trying to show you is the volume of issuance, and you can see that the recent years have been reasonably tough in terms of attracting new debt securities, the number has plunged significantly. We have not even been able to hit $1 billion in terms of new issuance in the last 2 years. And there have, and wherever you see the jump in this particular bar in terms of volume, those have been very specific issues coming from usually either a guaranteed sort of an instrument or some instrument which one way or other way has a very better rating. As I mentioned earlier, in terms of issues, the larger number of issues are coming from a few of the energy sector companies, and that's primarily because of the fact that the commercial paper market is a new market that's being developed in the Pakistan. Our mutual funds prefer to invest in commercial paper market, so there is a demand available and the supply is gradually building up. There are 3 or 4 entities in Pakistan that have captured this particular market, and they're very regular player in this short-term commercial paper market. But right now, still the players are not so many, and the same number of players who are issuing quite a number of commercial papers. And so far, what we have covered is we have looked at the overall design of the securities market in Pakistan, how it's bifurcated between equity and debt, and then when we go into the debt, how actually it's bifurcated between the government debt and corporate debt. And within the corporate debt, now what we are looking at is the penetration of the rating agencies, that how much of the corporate debt is rated in Pakistan. Over here, the good part is that you cannot issue, no corporate can issue debt to public unless it's rated. So which means almost all the corporate debt issued in Pakistan is rated. In terms, now the next slide is important. Over here, we have tried to capture how actually the overall rating curve is coming up for these securities. And here you can see that although the curve has a high sort of the mean is somewhere in A category, but when we look at the amount of the underlying issues, you can see that these are predominantly in high categories like AA and above. This otherwise tells you some sort of reluctance of the investors to go towards low rated instruments. But when I compare it with the so many other countries' presentations that have been shared, I think in case of Pakistan, our curve is reasonably better, that there is quite a bit of issues happening in single A category, and even we have issues available in triple B plus category. So from the rating perspective, although the quantum into low ratings is the amounts issued under the low rating is less, but the number of issues over there are reasonably good. So I think this is a positive sign in the sense that the market has receptiveness towards the single A instruments as well, and the market is not very much stuck with, say, like AAA or AA instruments. When no discussion about ratings can be completed unless one talks about defaults. Over here, I think as Pakistan, we have been reasonably lucky that there has been quite a less number of defaults over the last 10 or 12 years. Of course, the reason A is relatively still our mean rating curve is A. So theoretically, the likelihood of default in these categories is low. You can see that we have few defaults almost a decade back, and those defaults were primarily an outcome of the financial crisis that began somewhere in 2008, and these were the after effects of those crises. Once that particular dimension settled down, we have very few defaults. There have been years when there is no default in Pakistan in case of rated instruments. And then in FY19, we experienced a default, and then lately in FY21, there is also one rated instrument that has defaulted. So over here, the important point is that at least at the time of rating, the instrument was not enjoying a rating at a very high level. The both recent instances, the instrument prior to rating was rated in at BBB minus level. Towards the end, I would like to highlight few more initiatives that our regulators are taking to strengthen the debt market. And these are two interesting concepts that they have just rolled out. They have yet to produce any results, but actually these can highlight that our regulators are making efforts to develop our uh, bond market or our debt securities market. So the regulator has highlighted the concept of green bond, where there are going to be incentives if a particular bond or security is being issued to support the overall environment. And then there is also an incentive under the title of gender bonds. So where actually if a particular security is eventually going to help females, so there are going to be some sort of regulatory support available. This brings us towards the conclusion of our today's presentation. So just a recap, Pakistan is an economy of close to $300 billion. Out of that, our equity market is almost our equity market is something like close to $50 billion. Debt market is $150 billion. Debt market is dominated by the government securities. In terms of investors and sectors, in our equity market, we have reasonable diversity, but in terms of our debt market, it's predominated by commercial banks, and the instruments that have been issued are something close to 80, and in monetary terms, they are just $3 billion. Most of them are rated in terms of numbers in single A category, but in terms of volume, they are predominantly in AA and above category. Our regulators are taking reasonable initiatives to strengthen the debt market in Pakistan. But on the challenge side, still we, despite being an economy, a country of more than 200 million with an adult population of more than 100 million, there are still just 250,000 investors in Pakistan that invest in equity market and debt market. That's quite a small number in terms of the pool of investor available. Second challenge to the development of non-government debt market is that the government is the borrower in Pakistan offering good returns, and which effectively actually minimize the incentive for anyone else to come to this particular market. And then the banks being happy in terms of their liquidity are in very good position to offer good bilateral arrangements to corporates. So corporates usually does need not to come to the debt market. So this is what Pakistan's economy, capital market, debt market, and rating universe is. Now I am open to any questions that we may have in this regard, or any specific area that someone would like me to explain further. And thank you for listening to me.
Thank you, Shahzad. Thank you very much. We will entertain some few questions before we proceed to Mr. Muzaffar Ahmed. But we will have an opportunity to ask more questions towards the end of our webinar. Do I hear anybody would like to ask a question? Anybody?
Auntie, this
Yes,
is
Masuda-san.
Yeah, I'd like to have a very short questions. Thank you very much for a very comprehensive and a nice overview about Pakistani capital market. And one thing I'd like to ask about investor side. And I understand you rated 79 bond instrument. Who are the main investor? Any bank can purchase of those securities, or pension funds, asset management? Who are the investor to the debt securities? That's my question at this moment.
Thank you. In case of Pakistan, there are two distinct types of issues. One, as I mentioned, there are quite a bit of number of issues from commercial banks to secure or to support their capital. In those instruments, there have been lot of non-bank investors, predominantly the mutual funds, and also quite a bit of provident funds or the employee retirement benefit funds as well. And in case of non-financial institutions issues, the banks are there as investor in sizable numbers as well. But we have banks as investors, we have mutual funds as investors, and then our retirement plans being run by the corporates are also investors in those instruments. Then there are quite a bit of large holding companies in Pakistan. So they also invest in these instruments as part of their liquidity management or otherwise as part of their investment book management. As far as direct retail investors are concerned, they are far and few. And if anything, they are there usually through mutual funds.
Okay, thank you very much for your explanation.
Thank you.
Next question. Okay. Shazad, just for you to understand, you have the classifications.
Yeah, I have a question to Shahjad. Thank you for your
Go ahead. Shahjad,
can you explain or can you give me an idea about what is the flow of foreign investment in Pakistan capital market? And this is my first question. Another question is that do you in your capital market there is a treasury bond is highly dominating in the capital market, but is the treasury bond traded in the secondary market? And another question is, what is the tax benefit of the listed and non-listed companies in Pakistan capital market?
Okay, so gradually in terms of firstly the foreign investors. So foreign investors in terms of equity market, they have been reasonable. They have been a consistent player in our equity market, and sometimes their participation in terms of the volume traded on a particular day may go as high as 30 or 40%. And there is very elaborate investment structure available through which they actually come and invest. So it's all very regulated. They come, they bring their money into a particular account, and from that particular account, they invest in the capital market. And whenever they actually divest from the capital market, their money immediately get translated back into US dollars. So from the perspective of foreign investors, investing in Pakistani equity market is really easy, and they usually participate reasonably in Pakistan equity market. And I think the right number is how much their contribution usually is in the traded volume. So there are days when they actually contribute something like 20-25% towards our traded volume. And now when we look at our government securities, so historically the structure to invest in government securities wasn't very clear or easy, but lately the government, the Central Bank of Pakistan, the State Bank of Pakistan, they have made it much easier for foreign investors to come and invest in government securities. This is a very recent development, and the volumes are building up in that regard. But there are a couple of billions of dollars that are now invested in government securities through this particular process. Now moving to your next question, and that's with reference to tax incentives for any company in terms of listing. So the answer is right now there are no tax incentives. Traditionally, the listed companies used to enjoy a slightly lesser tax rate compared to non-listed companies, but right now there is no such incentive available for listing in Pakistan. But at the same time, SECP is coming up with a sort of a board where they would encourage small companies, say like companies with capital of something like close to $2 million, to get listed. So over there, the SECP is thinking of offering some incentives for bringing those companies there. But for a regular company, there is no incentive available. So,
Okay. Any other question, please? Shazad, for my education, you make a classification of short-term, long-term, and Islamic bonds. What's the tenor of Islamic bonds?
In Pakistan, somehow the most preferred tenor for instrument is 5 years. So
5 years.
usually the most of our bonds are 5 years. Lately, few commercial banks have tried to issue bonds which are of 10 years, but like the market acceptance is high for 5 years bonds. There are few bonds which are of 3 years term or like 10-year terms, but predominantly it's 5 years.
Thank you. Any other questions so far? Can we go? Then I'll ask one last question. Then we'll go to Bangladesh. Slide 21, Shazad, could you go there? Oh, yeah, the yield, yeah. I'm looking at this very abrupt changes in the yield curve. Shazad, this is fiscal year 2019, 2020, then 2021. During this period, how did the corporate debt market react? Was this a period when there were no issues, private corporate issues, or more corporate issues, or just stand by and wait? In other words, what did this experience, this sudden yield curves, how did it affect the private debt corporate market?
So in terms of private debt, rated debt instrument market, it has impacted negatively. And the total issues in this period, like in the last 2 years, has been less than $1 billion. So the total all issues combined, the amount issued was less than $1 billion. So it hasn't impacted that particular market positively. But that's just not the reason. The other reason is in this period, the flow of money in Pakistan from banks has increased significantly. And because of which there was a high willingness on the part of banks to lend money to corporates. So the debt market, A, because of this interest rate movement, and B, on the part of ease of money availability from the commercial bank, actually was cornered.
Thank you. Thank you. Okay, we will entertain more questions after our next speaker. It's getting because it's too many interesting things going on in Pakistan. But let me introduce very briefly Mr. Muzaffar Ahmed, our next speaker. He's one of the originals. I really just want to give him a very short introduction. He's one of the originals of ACRAA. Right from the start, he was with ACRAA together with Mr. Fahim Ahmad and myself, who are still, over these 20 years, still active in ACRAA. He is, well, let's call him, he's still an icon in the financial markets in Bangladesh. He pioneered credit rating in Bangladesh by establishing the first credit rating agency. But I will not say more. We can just listen to him and we will know how he is so qualified when we listen to him. May I present to you our next speaker, Mr. Muzaffar Ahmed, President and CEO of Credit Rating Information and Services Limited.
All of you, especially Shanti, for making a wonderful, combination of the economics of ACRAA, and to have presentation, which is absolutely professional, I believe, and very interesting also. Now, today, Shazad make a wonderful presentation, and once we are all in one roof, Pakistan, East Pakistan, West Pakistan, now we are apart, is a different country, but our economy follows the same pattern. So Bangladesh lies in the northeastern part of South Asia. You know, the country is bounded by India on the west, north, and northeast, while Myanmar on the southeast and Bay of Bengal on the south. It's a new country in Southeast Asia after separation from Pakistan in 1971. The area of the country is 56,977 square miles, and population is about 160 million. Our GDP is approximately 324 billion, reserve about 45 billion, densely populated, and per capita income approximately 2,200 US dollar. Male and female ratio is almost equal. Just to give you an idea about what we are now in Bangladesh. Coming to the Bangladesh economy, the growth rate, GDP growth rate is 7 to 8%, which is noticeable. Reserve by this time has exceeded 43 billion US dollar. So this is a spectacular growth Bangladesh has been facing for the last few years, except the COVID, where our GDP growth rate has reduced to 5.24%. And in the South Asia GDP economic size, I think already Shahzad given some idea, but in 2020, what we have seen Bangladesh compared to Pakistan and India, it was, you know, at the initial stage, the Pakistan was above Bangladesh, where in 2000 it was 249 billion in GDP against Pakistan 304 billion. And 2018, it is 74.04 billion against 314 in Pakistan. And 2019, it was 302 billion against 278 billion. That is started moving upward. And in 2020, it was 324 billion against 263 billion in Pakistan. The India is not comparable because it's quite a big country. Coming to Bangladesh capital market, as you know, Bangladesh capital market is the best performing equity market in emerging Asia with a return of 21.3%. This was an impressive recovery after the market shut down for 66 days in Q2 due to COVID-19 lockdown. Average daily turnover increased from Bangladesh taka 3,864 million in the first half of year to 8,233 billion. The average turnover for 2020 as a whole, Bangladesh taka 6,489 billion. We expect the rally to continue with a central target of 7,000 marks index. Now, at present, even today, it is 6,400 market. So by December, we expect that this will continue to be at 7,000. The above is mainly fueled by liquidity surplus, interest rate declined by the government, budgetary support like tax at reduced rate. All these together fuel the capital market. Although started journey long before in 1954, it is still at the rudimentary stage in terms of market size, market depth, and market capitalization. Bangladesh capital market is mainly dominated by equity instruments like Pakistan, and presence of debt market is very low. Although government treasury bonds are listed, the trading is almost nil. Only few banks participate in the treasury bonds, are mainly held by the scheduled banks to maintain their SLR. There are two stock exchanges in the country. One is Dhaka Stock Exchange, that was set up in 1954. Chittagong Stock Exchange was established in 1995. Trading is conducted by computerized automated trading system. Stock exchanges are self-regulated, private sector entities which must have their operating rules approved by the Securities and Exchange Commission. And there are only one depository, it's called Central Depository Bangladesh Limited. It was incorporated in August 2000, licensed by Securities and Exchange Commission in 2003. The core service of depository is the sufficient, efficient delivery, settlement, and transfer of securities through a computerized book entry system. Now coming to the market intermediate, who are the players? We have got 250 track holders or brokerage firms in DSC, 146 brokerage firms, 64 merchant banks, 50 asset management companies, 8 custodian for mutual fund, 11 custodian for securities, 8 trustees for mutual fund, 84 trustees for debt securities, 6 trustees for alternative investment fund, 21 fund managers, and 8 credit rating agencies. They are called the market intermediaries. Now, about the participants in the capital market, we have got 609 companies in the market for the players. That is, their securities are listed. Out of that, important are bank 31, engineering companies 42, financial institutions 23, food and allied 20, fuel and power 21, and insurance companies 51. Mutual funds 37, pharmaceutical and chemicals 31, and textile, which is a very important sector for in Bangladesh now, including garments, which is 58 companies listed, and treasury bonds 221. In total, 609 security companies are playing the market. Coming to the concentration of the securities, here you see the bond market is covering 36%, textile 10%, engineering 7%, and other insurance 8%. Together, all these 100%. On the point of instrument, that is equity instruments. If we convert these to in terms of instrument, equity instrument playing a very dominant role, which is 56%, and treasury bonds 36%, mutual funds only 6%. Now, coming to the other categories in the Dhaka Stock Exchange, we call A category, B, N, Z. A category means who are declaring dividend 10% and above. B category, dividend declared less than 10%. And new category means newly listed companies. And Z category means problematic companies. Coming to the market capitalization of DSC, it is DSC stood at 5,200 billion on May 27, 2021 in US dollar 59.28 billion, which is 18% of the GDP. GDP is 324.2 billion. Market capitalization, I'm not taking so much on this thing because it's already discussed, I think, in one or the other. Now coming to the market cap by the sectors. This is very important because this manufacturing sector covers 41.12%, banks and financial institutions 22.18%, and bonds only 0.10%. That is, this is the absence of the bond market, as I told you earlier. This is the by securities, that are securities, company shares, mutual fund, debentures, government treasury bonds, corporate bonds, that I'm not going to discuss along because I want to give you in at the later stage of my presentation. Turnover and market capitalization, that is financial sector, banks 11%, financial institutions 10.89%, insurance companies 7.22%, and total 29.17%. It is about the market capitalization of the financial sector. Similarly, market capitalization manufacturing sector, which pharmaceutical companies plays the dominant role, which is 13.14%, and cement only 3.86%. Others are engineering 6.92%. Which are less than 4%, others. Coming to the turnover percentage and market capitalization, that is again, mutual funds is very less, fuel and power 10.64%, and other miscellaneous including service and others is 12.69%. Here, if you compare the market capitalization in terms of the securities, that is corporate bond almost 0.01%, and others, actually you see this is the market position. The bond market is absolutely very less. Coming to the credit rating agencies, the question comes: at present, 8 rating agencies are operating in the country. It is hardly possible to survive even a single rating agency in absence of debt market, as all of you are aware. Securities and Exchange Commission rules provide for equity rating if the equities are issued at premium, which we are now called, it's called a book building method. That is, if you issue equities at higher than the equity price with the face value, then it needs a credit rating, otherwise no. However, the rating agencies are operating mostly in the Bangladesh Bank's regulation. The Bangladesh Bank regulation provides for mandatory bank rating every year, client rating by banks to comply with Basel 2-3 capital adequacy requirement, issue of debt instruments like subordinated bonds, perpetual bonds by banks to maintain capital adequacy. This is going on. Insurance regulators also made it mandatory to rate the non-life insurance companies every year and life insurance companies in every alternative years. Then how it is surviving, how the 8 credit rating companies are operating, mainly because of capital adequacy requirement, because if unrated, for unrated clients, that they are required to provide 120% requirement of capital adequacy, and if it is rated, it goes by the rating by itself. So most of the banks are getting the clients rated so that their capital adequacy. Normally in Bangladesh now, the capital adequacy is almost at minimum. Particularly the local banks are as against a requirement of 12% now, that they have got either 12% or maximum 13 to 14%. So under this circumstances, they are required to rate their clients by rating agencies approved by the Bangladesh Bank. So that is how these companies are working, particularly in the banking sector, not in the capital market. Coming to the price earning ratio or dividend yield, Bangladesh price earning ratio compared to India, Sri Lanka, Thailand, Bangladesh, and China, it is 14.75% price earning ratio. Dividend yield is 3.39%, and market capitalization GDP, it is 16.03%. And compared to India, it is quite high. Your price earning ratio 26.08. Dividend yield is less, 1.05, and market capitalization to GDP is 81% in India. And Sri Lanka is also almost now at present is almost same like Bangladesh, and others are quite high. So this point I was telling that now Sri Lanka and Bangladesh are almost same in terms of GDP, that is 17% of the GDP is now in the market capitalization. Coming to the sectoral price earning ratio, price earning ratio of the banking sector is still very attractive compared to other sectors. That is, most of the private sector banks are listed with the Dhaka Stock Exchange, Chittagong Stock Exchange, and the price earning ratio is quite low compared to other countries and other sectors also in the financial sector and mutual fund, whatever it is. This is quite low, and people are now more attracted towards investing in the banking sector. Although banking sector has been enjoying a lot of opportunities from central bank, taking the advantage of COVID, and which is also a problem for the rating agencies, because when before a client defaults, the central bank giving them time, allowing almost 180 days to defer it, so they cannot say that they are default. So this is creating problem, and also in terms of provisioning requirement again non-performing loan or stress asset. Now they are this thing they are deferring. Central bank itself is allowing the banks to defer certain of the loan provisions. As a result, the price and earning seems to be attractive, which is absolutely temporary, but the public is towards now the investing in the banking sector, which is giving a dividend about 10 and above %. There is interesting information that top 20 securities in the Dhaka Stock Exchange, also in Chittagong Stock Exchange. You see cash dividend. Some of the companies are giving quite substantial amount of cash dividend. That is, some of the companies like Reckitt Benckiser is 1,250%, and followed by so many Singer 77%, and some other companies doing substantial cash dividend as well as your bonus shares. I'm not going to discuss the top 20 securities occupy. This is interesting is that the 20 securities occupy 61.25% of the market capitalization. That indicates that our market is compared to other countries is shallow, because some of the companies, it is 61.25% of the total market capitalization is with the 20 securities in the market. And that I'm not going to, I think, discuss, because this is the Dhaka stock market data. For information, I just collected it. Now, the market capitalization on 28th July, that is 5 billion in US dollar, the 62 billion market capitalization very currently started. Coming to DSC index and monthly turnover, that during COVID-19 period lockdown, the index and turnover continued to rise. This is very interesting thing for the Dhaka Stock Exchange. That is still it is rising. This is also a DSC compared to global market. That is index is Dhaka Stock Exchange is following the tradition of the international market, global market. They're almost in the same pattern. As I told you that corporate bond market is absolutely at a very low level. About 80% bonds in Bangladesh market are issued by banks and financial institutions to meet regulatory capital requirement. Yield of corporate bonds in case of Sharia-based banks, coupon rate is tagged with 6-month average of MTDR rate with additional 2% margin. And in case of conventional banks, coupon rate is tagged with a 6 months FDR rate of peer banks. In case of zero coupon bonds, bondholders other than banks and financial institutions, insurance companies enjoy tax benefit. That is one of the interesting things, because when we started in Bangladesh, these banks and financial institutions were given some incentive, tax incentive for issuing zero coupon bonds. So banks started, one bank issued the bonds, other banks are investing there. That gives them some tax benefit. Ultimately, after 2 years, the central bank has stopped it. So now, in case of zero coupon bonds, only the companies other than bank and financial institutions, if they invest in that company, they are getting tax benefit. Now, whatever we have bought bonds, most of the banks are rated either AA or AAA, except only few 5% which is A-. This is mainly due to the fact that banks which are having a good standing, they are issuing the bonds, the perpetual bond or subordinated bond. That is, the rating seems to be quite high. This is all about a history of Dhaka Stock Exchange, which I'm not going to discuss. But starting from 10th June 2012, the lot of changes are taking place in the Bangladesh capital market. like DSC became the correspondent member of World Federation of Exchanges. It started DSC Broad Index, and exchange demutualization took act in 2013 that gave a long boost to the capital market. Transparent to demutualized exchanges, all this together. I'm not going to list all this, it will take long time. And now, in 2018, Dhaka Stock Exchange received money from the Chinese consortium, that is Shenzhen Stock Exchange and Shanghai Stock Exchange, for selling of its 25% share. That means the Dhaka Stock Exchange is actually jointly operated by the Chinese Shenzhen Stock Exchange and Shanghai Stock Exchange, that have given a boost to the Dhaka Stock Exchange. 25% shares of DSC has been transferred to Chinese consortium, DSC's strategic partner now. Yes, DSC joined in the next platform, that is the next alliance platform, integrated market intelligence, displaying buy side as well as sell side information, cultivates the market and conducts project fund messing. And the platform debuted in 2014 and has already gained international recognition. More than 40 countries, including China, are currently operating the next platform. The potential companies of those countries have been able to meet the capital requirements to achieve and expand business goals. The online technology-based VNext platform has become a worldwide gathering of investors. The VNext is acting as a bridge for potential sector of the country to reach its desired goal through foreign financing. I'm not going to discuss all these things. Now, some of the very interesting recent developments that I want to discuss. The amendment of Security Exchange Commission Debt Service Rules 2021. Initially, for credit rating, the only one rating and only one act was there, regulation, that is security, the Credit Rating Companies Rule 1996. Now, wherein it was because no debt securities can be issued, or any right issue can go with if it is at premium, unless and until these are rated. Now, Securities Exchange Commission has come up with the Debt Securities Rules 2021, where they want to emphasize that all the debt securities has been rated, and the rating agency which are being selected is to continue till the maturity, till the last payment of the bond. That is one thing. The other thing, that these rating agencies must declare what is their default statistics on particular rating criteria. For example, if you rate a security as AA, then you will have to give the default statistics. What is your default statistics in that particular band of the rating, so that it can be accommodated there. So these rules are not there, but now it is coming up. So this is an interesting development for the credit rating agencies to see the debt securities ratings. ESCC Capital Market Stabilization Fund Rules 2020. This is also very interesting, because for the last many years, many companies declared dividend, or they have taken the deposit, share deposit money, that not 100% are refunded. That means many, the security holders, either they are not claiming, or they lost their address, or they changed their address. As a result, substantial amount of money is lying with the listed companies which are with the Securities Exchange Commission. Recently, they moved to the Capital Market Stabilization Fund, asking all the listed companies to transfer the dividend not paid, unclaimed dividend, after more than 3 years, which are lying with them more than 3 years. So that has created a lot of impetus in the market now. there are many companies which have got the last 20 years, they have got the record of not claiming unclaimed dividend, and that is now being the Security Exchange want that this should be moved to this capital market stabilization fund, which will be operated by a board under the supervision of the Securities and Exchange Commission. So this has created a lot of impetus now in the market, and also hue and cry because they required to pay a huge amount of money, the listed companies, to this fund. PSSC investment also Sukuk rules 2019, they made Sukuk rule, that is Islamic bond to be issued. Government by this time has also issued some Sukuk for safe water, drinking water, and that got a lot of impetus from the investors, and it was 14 times, 4 times oversubscribed. So government is continuing with this issuance of Sukuk, and they are also planning to bring green bond under Sukuk, so that the Bangladeshi, most of the 80% people are Islamic minded, so they want to have the Sukuk rules to place in the securities market. The now draft amendment of credit rating companies rule 1996, which has been in existence since 1996. Now the Securities Exchange Commission want to make it the lot of changes they want to take place. That is, they will not make the rating mandatory, since debt instruments they already have governed debt securities rule 2021. So they are going to change it. Then regulatory compulsion of listing perpetual bond. This perpetual bond is a very recent phenomena, because banks initially started issuing subordinated bonds to make their capital adequacy, to maintain their capital adequacy. Now it appeared that these subordinated bonds are required to refund within 4 or 5 years by installment. As a result, if they issue a subordinated bond, then they require to refund it, and as a result, their capital requirement is now again shrinking. As a result, these banks are now going to the perpetual bond. That is, side by side, this is not refundable, but it will continue like a capital. Now, Securities and Exchange Commission, they want that these perpetual bonds being issued by the banks, a portion of it, 10% of these perpetual bonds is to be listed with the Dhaka, the stock exchanges. So that is also going to bring some changes in the bond market, and these perpetual bonds being a debt instrument is to be rated by rating agencies under this debt security rules 2021. So that is now in a very hot point of discussion at present. Mandatory investment requirement in the listed debt securities, that is for the this mandatory investment requirement in the listed securities for the banks. That is, central bank is also coming up with this sort of rules that you will have to invest. Particularly, the merchant banks are required to invest in these debt securities at certain portion, 3%. Deduction of corporate tax rate for being listed. Now, if it is for all unlisted companies, the tax rate is 35%. Now, for listed companies, they reduce it to 25%. So there is a wide gap, and that is to encourage the companies to have listing with the coming up in the capital market. Fiscal support to whiten undisclosed money through investment in capital market. That is a very interesting, this continuing for many years. If you have got enough money which you have not disclosed, and there is remaining black money, you call it black money, and this black money has got the option to come in the capital market with paying certain amount of flat rate tax. Regulatory binding by BSE for public offer at least 10% of the perpetual bonds I already discussed. Direct listing of 11 perpetual bonds, that is, Securities Exchange Commission already instructed the bonds they approve earlier, they go for the public offering. Mandatory investment that I already discussed, 3% of the securities. The BSEC has taken several investor-friendly initiatives, that is, investor protection fund by collecting unclaimed dividend. As I told you, they are trying to have fund for to protect the interest of the investors, faster approval process of IPO, to bring transparency and trust in the trading system, and updated surveillance software, starting the implementation of holding 2% of total capital for individual directors and 30% of the total capital for all the sponsor directors of the company. There are certain, it has been observed that some of the directors, after issuing the share, they are selling their own share when they are getting good money in the capital market. Ultimately, their interest in the company is being jeopardized. So now Security Exchange Commission made that at least the directors will have to have 30% shares, and minimum, in order to be in the board, one individual must have at least 2% shares in the company. That already I discussed. The issue shall not be rated below minimum investment grade of AAA or equivalent rating in the long term, or that is for bonds. If the bond is below BBB, then that will not be accepted by the Securities Exchange Commission. Capital Market Stabilization Fund, I also discussed. Now, Bangladesh Bank issued a circular on February 10, 2020, giving permission to all the scheduled banks to form a special fund of 200 crore each to invest in the capital market. This is again against a normal banking norm, where banks are normally not allowed to invest in capital market more than 20% because of the many risks involved. However, now two regulators, one central bank, other Security Exchange Commission. Since market is dominated by the banks, the Security Exchange Commission wants that the banks should invest more in these areas. But being commercial bank, they are taking unnecessary risk in investing in the capital market, as we have seen. And here, central bank again are asking the banks to give 200 crores each to invest in the capital market, which is again very risky, and it is against the normal principle, in my opinion. The scheduled banks can make a combination of their own finance and credit from central bank through repos to set up the fund. The fresh investment that would be made by the banks under the facility would not be calculated as their solo or consolidated capital market, capital exposure. Okay. This special fund, as the Bangladesh Bank is now asking the banks to make a fund of 200 crore. The amount the special fund will be invested in equity shares, mutual funds, bonds, and debentures. The bank may lend money to share market intermediaries by charging maximum 7% interest rate. That is also against the normal, I should say, normal investment, because commercial banks are required to look at the commercial interest, but these are all things are required as directed by the central bank, which is against the commercial interest, in my opinion. Okay, tax rate I already discussed. As regards the recent past, Finance Act 2021 paved the way to quite an undisclosed money through investment in capital market in the next fiscal year 2020-21 discussed. Under the new provision, the highest tax rate of 25%, along with 5% penal tax will have to be paid on the computed amount of taxes for investment of undisclosed money in the capital market. We are coming to again the Sukuk point. Bangladesh Bank government issued first sovereign investment in Sukuk for raising fund aiming at implementing a project titled Safe Water Supply for the whole country on 28 December 2020. The government planned to raise again Bangladesh 80 billion through issuing Sukuk for implementation of the 5-year safe water supply to the whole country project, which began in January 2021. The Bangladesh Bank acts as a SPV on behalf of Minister of Finance, the originator of the Sharia compliant sukuk, arranged first auction of 40 billion Ijara sukuk on 28 December 2020 with a 5-year maturity period. The first auction got response from 37 institutions, both conventional and Sharia compliant financial institutions, and 2 individuals, and was oversubscribed to 151.53 billion. So again, coming to summarize the thing, the capital market of Bangladesh is a equity-based market with with low market depth, absence of debt securities. Banking sector is open for the long-term financing side by side with the short-term financing. That is one of the very important factor why the capital market is not developing in Bangladesh. Because if any organization comes under Securities and Exchange Commission and listed companies, they require to go through a lot of formalities. Whereas if they take money long-term loan from the bank, they are only satisfying the banking the board of directors of banks, not to the public. As a result, normal tendency is to go to the bank instead of coming to the stock market. So as we have been telling to the central bank for a quite long time, that there should have a cap on and allowing the companies to take long-term loan. They should provide short-term loan, and for long-term loan, they should go to the capital market. That it is not being is followed in Bangladesh. That is why for the last 20 years almost, government has been trying to develop the bond market, but unfortunately it is not there. Lack of linkage of financing between capital market and bank, absence of stable fund for such a pension fund, life insurance fund, retirement fund from banking and government organizations, these are not in the, still not in the capital market. As a result, capital market is lacking sufficient required depth. So this is all about Bangladesh capital market, and I tried to shorten it because it is so many slides. I have not gone to in the greater detail. If any of you have any question, you can ask me that we can discuss it. Thank you very much.
Thank you, Muzaffar. That was a very comprehensive presentation. I will now entertain questions from anybody and everybody, even before I ask my own
Sandy,
question.
may I have some comments here?
Yes.
Yeah, thank you. Welcome, everybody. The issue is that in my experience over 30 years now in the rating agency and with ACRAA and going into so many jurisdictions, whenever we talk about the debt market, I think I've been giving presentations to the different governments and the central banks. The issue is the absence of Santi, the absence of in Asia and even in European countries, the absence of long-term the mortgage market. Because unless and until you develop a long-term refinancing of mortgage MBS, the mortgage-backed securities market, that's a long-term tenor, and that helps to deepen the market. Look at USA. If you look at I'm just recalling some numbers. If you look at the capitalization of USA market about 3-4 years back, it was about $20 trillion. The debt market was about $40 trillion. So it's very natural that your debt market is double the size of the capitalization of the equity market. Now look at our numbers. Whatever we have seen in Malaysia, then Thailand, then Pakistan, Bangladesh, and maybe Philippines, the equity market has a very huge capitalization and the debt market is very low. The issue is, in my personal belief, is the mortgage market. We should now concentrate as ACRAA that we should influence the governments. And recent development, I think Shahzad missed this reference to the recent development in Pakistan, not for the debt market, but for the loans against the housing finance. So if that develops, and then the banks are going to refinance themselves, then we are on the right path. Maybe Mr. Masuda can appraise us. I remember when I was studying Japan, Japan has also a very sizable mortgage market, because that gives you a very deepening effect. So that was my comment, because in Turkey also I've looked at, and they lack this, and Turkey is a $100 billion market, GDP, and like Indonesia also. Malaysia has done something on this, but I think this is a mix we are missing, a critical mix, which is very important for the development of the debt market.
Respond, Mr. Ahmed. Muzaffar, you want to respond?
So the mortgages, I agree with Fahim that the mortgage market is still to develop. This is a long way to go, and I believe that this is the area where the ACRAA should focus. In Bangladesh, actually, our mortgage market is far away from coming to the capital market, because this is essentially required, I believe. But in Bangladesh, it is it is a very at infant stage, I should say.
Masuda-san, you want to say something?
Thank you very much for
Masuda-san.
this opportunity. Can you hear me?
Yes.
Yes, yes.
Okay. In Japan's cases, and the official support to those and housing loan is very important. And there is one official company who support to the mortgage loans. And this one issues a long-term public bonds, not rather than the MBS. I think in United States the case, Fannie Mae, Freddie Mac, they're supporting those areas, and those kind of design of market instrument is respect to the market discipline, market mechanism. So that's depend on the how do you design of public supports and or to those and the housing loans. Particularly, housing is a politically sensitive area that the government may want to direct step in to support of those housing lending. So it's very good idea that following to the United States type market-driven housing loans that will generate to the activate. I quite agree that Hafim's opinion. Thank you.
Okay, any question from some others?
Taking this opportunity, I have one question.
Okay.
Masuda, continuously speaking. And I'm quite amazed at those and the credit rating agencies situations. That 8 credit rating agencies are competing in this market. That is a notable difference with Pakistan. And 2 questions. How issuers decide to their choice regarding to credit rating agencies? And the second question is how all those credit rating agencies competing each other to selling to their appealing to issuers in terms of pricing and in terms of the quality of credit rating. Can you a little bit and explain those competition aspects of credit rating agencies? Thank you.
Thank you very much for the very important question, which I tried to avoid. Because when the Basel II was implementing in Bangladesh, then central bank thought that we have got around quite a substantial amount of SMEs that need to be rated, although very not more than 200, 300 corporates in Bangladesh, but we have got 80% of our bank financing is in the SME sector. So central bank asked the Securities and Exchange Commission to give license to more rating agencies. When there are only 2, the CRISIL and the ACRAA, 2 rating agencies were there at that point of time. So now Securities and Exchange Commission given license to some of the politically motivated people who want to do business. And there are, initially it was 7.5. That means 1/2 for only SME. Now they are given full license to do also the corporate corporate ratings. Now 8 rating agencies, you see the rating price has substantially low, It has gone below the normal situation, I should say. I don't like to mention it, but it is very, very, very low. As regards quality of the ratings, that has also gone low in this sense that especially the CRISIL is now losing many bonds because they want the bonds should be rated AAA. But unfortunately, we are unable to give them AAA for many reasons. For example, a perpetual bond. For perpetual bank, a bank is rated say AA. They want the perpetual bond should also be given AA. So this is who we disagree, because whenever we are rating a bank, that we are giving rating based on the loan they have provided, the quality of the assets. But for perpetual bond being almost near to the equity, that cannot have the rating equivalent to these banks. As a result, we, the rating agency, CRISIL especially, losing many clients who are not coming to us because if they believe that if they go to CRISIL, that will not give their expected rating. That is how it is going, quality in terms of and price also. So that is the things which I want to avoid, but you bought the subject, that is why I'm telling. Thank you very much.
Okay, any other questions or comment?
So, hi, this is Shazad again.
Shazad, yeah, go ahead.
I have a comment with reference to the comment that actually Sanisa made, and I would just like to share one of the slides that I earlier shared.
Yeah.
So I think now everyone can see it. Yeah.
Okay, we see it.
So now when we look at this slide, and this is more with reference to the comment that Sanisa made, so we can see here that actually within the ACRAA members, debt security market is either equal to or in certain cases even larger than equity market. So which means in addition to the housing finance or housing refinance bit that Himsab is talking, there are few other initiatives that actually all of these markets are taking. Probably the only exception here that we can see is Pakistan, where equity market or debt market are too small. But otherwise, in case of all other countries, these are reasonably big. So maybe in some of your next sessions, ACRAA can build on this bit, that how actually the non-government debt market is coming up in these countries, and what are the factors that are supporting the development of government debt market. That's A side, and B side is the penetration of the rating agencies into that particular market. So while I agree with the FinSab's comment that the development of mortgage or any type of loan books that are again brought into the market and sold in the form of bonds always help in development of that market. That point is very valid. And in case of Pakistan, there have been definitely few developments in supporting the mortgage market. But those are really in infancy. Thank you.
Any comments on the comment? Well, if
I have a question to Mr. Shehzad.
Yes, go ahead.
And that is, does SCCP allow SMEs in Bangladesh to be listed in the country's main exchange? Are they can be listed in the stock exchange, SMEs?
Yeah. Yes, in case of Pakistan, actually there are listing requirements in terms of capital, and now SCCP is working on bringing a new board on stock exchange, where they are going to encourage companies having capital in rupee terms just 200 million rupees, or in dollar terms even less than $2 million. and where actually I think when the relevant regulations and everything would be out, so we may see quite a bit of SMEs approaching that particular market, but it's still in the process of making, and I think once it's out, it may encourage listing of SMEs. Right now, the current requirement is that the issue size has to be 100 million rupees minimum, and which means if a company is offering something like 20% of its equity, in terms of the overall size, it has to be 500 million rupees sort of equity, and that is definitely not an SME. So the current regulatory structure, it's not supportive to SMEs. It's supporting more like slightly larger corporates. But we are working on developing a structure which would support or help SMEs in listing.
Does that answer your question, Asiful?
Yeah, thank you.
Okay. I'll entertain other questions. Did you want to say something, Muzaffar?
Oh, thank you very much. I think these two sessions covered most of the areas, and I believe this. I definitely appreciate the ACRAA is doing a wonderful job to bring all the economies together and to compare. And I would request you, if possible, that at certain period of time in ACRAA, that whatever we have gathered information through these presentations, we can try to assess, come to some conclusion of what about the economies and the market capitalization of all these countries. Thank you very much.
Muzaffar, I'd like to go back to those two slides of yours on your reform on hand. Can we look at that list again?
Which slides you are talking about?
Reform in hand to boost capital market. You have two slides of that.
Mr. Muzaffar, you will have to share screen again, okay?
This is also, I think you've come to these points. Anything?
Yes. Yeah, before
Mr.
that.
Muzaffar, I've shared.
Yeah, you have.
Yeah,
Before
okay.
that, okay. You know, you have a list. It's very nice, encouraging list. But what is really, I have some questions because I'd like to see whether this can apply to the Philippine situation also to boost capital market. But which ones of these are really what you think are more workable? And I'd like to ask, let's say Fahim. Fahim, I'm looking at him, all Pakistan and Shahzad. Which of these are really you think are workable in your respective countries? And which will work better? This is a long list. What's the timeline here, Muzaffar, and whose ideas were all of this? You know, you have 3 slides here.
Here, interesting thing is that the Capital Market Stabilization Fund, I don't know whether it is in Pakistan or not, but this is a recent phenomena that is introduced by Securities and Exchange Commission, and it is going to have quite a substantial amount of money to protect the investors. And I think, I don't know whether it is in Pakistan or not. And also Philippines, I don't know, you will be able to. And Sukuk is not the, Sukuk, we previously did not have any Sukuk rules. That is going to assist us to have, it's an Islamic country, you know, people are not interested in the bond, investment in bond, it is not halal. And now this Sukuk is going to have a boost on these things, we believe. That is why Securities and Exchange Commission is working still on these things. And credit rating companies rule, they are trying to bring some changes. We suggested that this should have a minimum fee for the rating agencies, because due to the competition, now rating agencies are offering quite substantial low fee for rating the SMEs and other corporate clients. So Securities and Exchange Commission is thinking to have some sort of minimum fee they should charge. That will, I think, that will bring some changes in the rating industry in the country. And listing of the perpetual bonds, this is a very interesting because it was basically it was previously with only banks. That banks are issuing perpetual bond, and it is issued by one bank and invested by other banks because investing in the corporate clients is risky compared to the investing in the perpetual bonds. Now, listing of these things will definitely assist the to have a big market capitalization of this bank because these bonds are quite substantial amount. So this is also having a this is an interesting idea of the Securities and Exchange Commission. So I think the mandatory investment requirement of debt securities, that is it is not only in the capital market, but all the merchant banks are required to, in their portfolio, they are asked to have at least 3% of these perpetual bonds, 3% of their investments in these perpetual bonds. So that is also going to have boost the, I think, the capital market. So, and also the corporate tax reduction to encourage the private sector companies to come up in the capital market, that is also very encouraging. So all these things together, I believe that this may assist the developing economies to have this sort of regulations to develop the capital market.
Thank you, Muzaffar Saab, and thank you. If you permit me, I'll just like to share in terms of all these things with the status in Pakistan. So Muzaffar Saab, if possible, kindly open that slide again. I'll just comment from the Pakistan perspective.
Which one?
Okay, okay, sure. I'm just sharing it, yes.
Okay, thanks for that. Okay, so the point number one, debt securities rules. So Pakistan actually has reasonably elaborate debt securities rules, and our SEC is vibrant in the sense that they review those rules at a regular basis, and whatever sort of suggestions from the market participants come, they try to incorporate those suggestions. In terms of the market capitalization fund, Pakistan Stock Exchange already has a already has a fund to protect the investors. But we don't have a market stabilization fund, because my understanding is market stabilization fund is the fund that would invest in the market to stabilize it. In case of Pakistan, we do have a fund that if something goes wrong with the investors because of some malpractice by the broker, so then the funds would be available to help such investors. As far as market stabilization is concerned, there is no regulatorily designed structure available to help stabilize the market. But traditionally, there is in a mutual fund in Pakistan where the government has quite a significant control. The government has used that particular fund to stabilize the market. Previously, that practice has been followed, but on the face of it, it seems good idea if any such fund can be developed. Number three is Sukuk. So in case of Pakistan, the Sukuk related rules are already there, and as I showed in my presentation, more than 50% of the current
disconnected. Hello, okay, where were we?
So in case of
Sukuk, so in Pakistan, these rules are reasonably well established, and as I mentioned earlier, more than 50% of debt securities, the corporate debt securities right now in Pakistan are under this Islamic structure. In terms of amendment in our credit rating companies rules, we are done with this particular phase. Our recent set of credit rating companies rules was done in 2016. So our rules are relatively new, and now SECP has a reasonably regular process where almost every 2 years they solicit suggestions from the market participants, and they are willing to improve those rules. In terms of compulsion of bonds, so there is no such compulsion of listing, and it is more a function of the type of investors and issuers. Mandatory investment requirement, I personally like this idea, and I think, and of course I'll ask Priyal and Fahim Saab as well, if we can work this within Pakistan, so it would be interesting where some sort of mandatory investment can be brought into the instruments being listed in Pakistan. In case of reduction in corporate tax rate for being listed, that's something which was tried in Pakistan for a couple of times. But in the recent federal budget, this particular relaxation has been taken away. It was there even in the last year. And in terms of routing of undisclosed money to the stock market, in case of Pakistan, there have been schemes in the past, but lately there is no such scheme available which would permit flow of actually undisclosed money to the capital market. Rather, right now it's very opposite in Pakistan, where there are quite a bit of restrictions, and the source of money has to be very transparent. Our know your customer, anti-money laundering laws, they are relatively stringent in Pakistan. So no such thing, I think, would be possible in Pakistan in times to come even. But when I look at, so most of these regulations, I think in Pakistan, we are ahead in terms of certain regulations, and there are few interesting ideas that we may sort of share with our regulators as well. But more than the regulatory framework, I think it's more to do with demand and supply. Till the time we sort of improve that demand and supply equation for that instrument, in case of Pakistan at least, we have experienced that the regulatory framework support doesn't help much in terms of bringing bonds or the corporate debt securities to the market. Thank you.
Thank you, Jalad, and thank you, Muzaffar. I'm afraid we have consumed the time we have allotted for this. I'm sure we do have questions. I do have a lot of questions, some more, but we will have more webinars. We have more meetings similar to this. And I just want to thank all of you for participating very actively